Good morning, good morning. Hope we're all well, enjoying the changing weather. So, we're heading for the biggest recession in 300 years, and we've been on lockdown. Economically, a lot of things are not looking fantastic, like worldwide and specifically in the UK. And we're heading into this, we're moving out of the dark into this dusk period. And one of the questions that everyone's asking is, why is there no deals to be done? Why are property prices not falling? We're in this recession. People are faced with losing their jobs. The economy, the GDP is down 25%. Employment's not looking. The prospects for employment's not looking fantastic. But why are property prices not falling? So it's reasonably success and failure are very predictable. And over the last 12 weeks, we've been walking our property entrepreneurs through every step of this and explaining how there's going to be three phases to this recovery. There's the dark phase, which we've been through, which is basically the 12 to 14 weeks of lockdown. Nobody knew what was coming, nobody knew what was happening, and we all had to sort of, second guess what we needed to do at each step, and we managed to get through that successfully. Now we're moving into this dusk phase and finding out what's actually going to happen. Most people's sentiment is that the property market's going to collapse, it's going to fall down. But actually, are property prices going down? Property prices in the main, obviously there's micro and macro markets, but in the macro level, the property market's not dropping, and actually there's some cases where prices are increasing. We've got some stock on the market at the minute. We've got a development block of flats, and we just flipped a property last week, and the demand for purchasing is actually really high. But if we're in this, if we're heading for this recession, why is that? Well, the reason for that is, obviously the government did quite a savvy thing where they froze the housing market for basically 3 months. And what that did was it suspended activity. So it meant that any reductions and motivated sales that took place weren't able to happen on a mass scale. So they basically froze the market to prevent any reduced valuations being registered, basically prevented the market taking that decline. And then on the way out, what we're seeing, there's a few elements to this. There's three main reasons why property prices aren't decreasing. What we're seeing is, coming out of lockdown, everything's been lifted, and what you're going to see is this pent-up demand in lots of industries. If you think about a coiled spring, so pent-up demand is like a spring being coiled and then being released, and it has that immediate release of energy, and then it will settle back down to its original state, in the analogy of a spring and some market demands. That pent-up demand of 3 weeks where people were going to buy properties, wanted to buy properties, had to move, was basically frozen. Now that pent-up demand is coming back, plus coupling the opportunists of everyone thinking there's some deals, or a lot of people thinking there's some deals, there is a lot of post-lockdown activity. It's quite likely, however, that this isn't going to continue. It's going to be an artificial spike. It's not a growing property market. It's going to be an artificial spike of pent-up demand, and then what I suspect will happen is things will level off and potentially even reduce. The reason that property, and we've seen this, retail, for example, retail came back last week, and there was a 2-day spike in sales, and then for the following 5 days, the last 7 days of retail back, or non-essential shops opening back up, there was a 2-day spike in pent-up demand. It's novel, it's exciting, there's pent-up demand, people want to go and get stuff. And then over the 5 days after that, it settled down, and it's now settled, week one of non-essential shops, and specifically retail, settled at 40% of trading, which, not only is it not sustainable, it's indicative of how of how these things are impacting the market. The property market's not hugely dissimilar in the fact that there's this pent-up demand spike of people buying properties, and it's actually forcing prices in some places up. Like our strategy in lockdown and coming out of lockdown was we'd offer about 90% of asking price and try and get some deals. And the reality was we didn't secure anything. I don't think we secured anything using that strategy. And actually the feedback we were getting from agents was that it was going above asking price. We're seeing more and more of this. The sites that we've got on market, we've got a development site, a 7,000 square foot business centre. We've got people queuing up to buy that or to view that. I think we had offers in on that yesterday. We've got a block of apartments, which we've got 5 people booked up to view this week. We had one property that we listed to sell last week, and it sold last Friday, Friday before last. There's definitely momentum in the sector, and people want to buy. So why are property prices not falling? Because there's obviously this pent-up demand, but at a macro level, you know, the economy's getting hit, we're heading into a recession, people are losing their jobs. How are property prices not falling? Well, there's three reasons why property prices aren't falling, and what these three things are doing is they're not artificially. Two of them are artificially. One of them is just a part, like a market consideration. They're artificially suspending the market, and they're doing this a lot with the economy, and we're going to see the whole thing tail off as the coming weeks and months play out. And the first one is the first one's low interest. Well, in fact, the first one is low interest rates. With low interest rates, even those who have taken a hit on income, furlough, losing their jobs, with such low interest rates, people on variable rate mortgages are obviously going to have a significantly lower impact than lower monthly payment than they might have had over the previous months, years, decades in property ownership. So the first thing is low interest rates. That's not really going to change. You know, if you look at the last time we dropped interest rates, it was going to be for 12 months, and it stayed for 6 or 7 years. And then the only way it went is south. We went from like 0.5% to 0.25%. Low interest rates are notoriously difficult to work your way out of as an economy, so they're going to be around for a while. The second one is furlough. There's a lot of if you include there's 9 million people on furlough. If you include the self-employed people, it's over 11 million people on furlough or the self-employed equivalent, and a high percentage of them are not going to be able to return to their jobs. There's no UK prediction at the minute, because, you know, we've only just started opening up retail and we haven't opened up hospitality yet. We really don't know what's going to happen, and it will depend on the volume of revenue we can push through these businesses, because the 2 metre distancing rule is just going to be crippling. It's quite likely today or tomorrow or this week we'll go down to a 1 metre plus ruling. We'll find out about that, and that'll make a big difference. But we don't know how many of these people on furlough are going to be able to come back. And what that's doing is it's artificially propping up the property market, because people will only sell if they have to sell. Like, people don't have to sell, they're not motivated to sell, they won't sell. And if you're on furlough, or you've got low interest rates, or the third one, which is mortgage holidays, if you can't afford to pay your mortgage and you put your house on a mortgage holiday, you have no motivation to sell. All of these things are artificially propping up the property market, and that's why. So that is propping up keeping the level of supply down, and then the pent-up demand is driving the demand up. So if we're talking specifically about pricing in any economy, any sector, in any industry, the whole pricing mechanism runs around the demand and supply. The whole pricing model is demand and supply. Demand at the minute is pent up, so it's high, and supply is reduced. I think we're below a third of the volume of stock that's available to buy at the minute is over a third less than it was for the last 3 month period 12 months ago. So we've got less stock and higher demand. Obviously prices are going to be stable, and they might even increase. However, what's going to happen over the next 3 to 6 months is the whole game's going to change, because furlough is going to either be tapered off or ended. So it means people are either going to lose their job or reduce their income. That's going to create some issues. There's a space of the market as well, and then mortgage holidays. A lot of people are sitting on mortgage holidays at the minute, which again is artificially suspending, artificially propping up the market. But that's going to come to an end, because mortgage holidays, there was a 3 month period that comes to an end this month. There's another 3 month extension which you can take. During this period, all the changes will happen, where furlough will come to an end, hospitality and retail will really start to settle, the dust will come up, and we'll see how heavily those sectors have been impacted. And as unemployment starts to rise, I mean, GDP's, it's going to take a long time to recover from some of this scarring. Unemployment's going to start to rise, which means incomes will come down, affordability will reduce. People will then have to start selling their houses, and this will be towards the end of this year and into next year. People will just have to sell their houses because they can't, they haven't got the jobs and they can't afford them. And this isn't just like graduates and people who work in hospitality. This is like the lost middle, as it's starting to be called. People who are on sort of £60,000 to £100,000 salaries, consultants, executives, consultants, who just, there just isn't the work to go back to, and they don't actually qualify for a lot of like there's obviously universal credit and furlough up to 2,500. They just fall outside of those schemes. So all of these things are going to, over the next sort of 6 to 12 months, going to increase supply where people have to sell their houses because they can't afford to stay in the house they've got. And that might be that they're downsizing, or it might be they're going on to universal credit. That's a very real thing. So supply is going to go up. And demand, you have opportunists and you have investors like us who'll go out and buy stuff, and that's, this is the market where you really do make opportunities. We're getting more liquid than ever. We're selling stock, we're refinancing, we're raising capital, we're getting investors on board, so we can, next year is going to be an absolute gold rush for, we're already buying some new companies, buying properties, buying developments. It's going to be in commercial, there's going to be ridiculous opportunities, but the people who capitalise on those are going to be like the first movers and the early adopters. The mass market is not going to move, so supply is going to go up, and then demand will reduce because unemployment is going to go up, affordability is going to go down, the finance market will probably lock up, and we're seeing this already. Residential mortgages have gone from 95 to 95 to, I think the highest buy-to-let mortgage at the minute. Somebody will have to actually put the stats in the comments, but it's already down to 80% or 85%. I know Nationwide last week dropped their highest resi mortgage now is 85%. I know a lot of lenders are following suit. There's going to be such uncertainty. If you're good for the money and you're prepared to go through the motions, you can raise it. But affordability is going to reduce, access to finance is going to reduce, uncertainty is going to increase. As soon as that trigger starts on the down valuations and prices start getting registered lower, then obviously the valuers will get nervous, and that starts to create a bit of a domino effect. Property prices aren't decreasing at the minute because the market is artificially propped up, and we're in this period of this sort of suspended market where we can't really see what's happening. The next 3 to 6 months is going to be absolutely key. We're calling it the dusk phase. So we've had the dark, the lockdown, we don't know what's happening. Dusk is now coming. We're starting to get some light over the landscape, and we can see, right, well, what is the actual impact on GDP? We've had a sharp freeze, we've had a pause to capitalism, a suspension of activity, which pulled GDP down over 25%. That's going to start creeping back up, but there's going to be elements of the market that will never come back. Elements of GDP will never come back. The high street, people like the Arcadia Group, they were on their knees before this started. The reality is we don't know until the sun comes up and we can see what's actually happening, what the economic impact is going to be. But one thing's for sure, it's going to take a while to recover from where we've been, and the next 12 to 18 months economically is going to be very challenging. For the mass market and the economy, there's going to be casualties, there's going to be fatalities, it's going to be very challenging. But for entrepreneurs, for investors, for those who are willing to pivot and move and change and adopt, without a doubt, there's huge opportunity. We're doing some of the biggest deals that we've done ever. In the last 3 to 6 months, we've done some of the biggest deals we've done ever. Repositioning some of our stock from we did one a few weeks ago from it was a big high end. It was a 15 unit hostel. We were going to convert 18 unit hostel, and we were going to convert it into 15 flats. As soon as obviously lockdown happened, things like that, we just pivoted it, turned it into LHA and social space and public sector rather than professional, and it's been one of the most lucrative deals we've done. So rather than previously we had a deal fall over, we had a lease terminate, we turned it around and it worked well. We've had investments fall over, and other businesses have challenges, but we just pivot, change, and adapt and adopt. So yeah, it's huge opportunity, but there's 3 key reasons why property prices aren't dropping at the minute. It's mortgage holidays, it's low interest rates, and it's furlough. 2 of the 3 are going to fall out over the next 3 to 6 months. Couple that with some uncertainty, some increasing unemployment and reduced affordability. It's going to be an interesting time. There's loads of economics, business bits and pieces I can share with you. Over the last 12 weeks, we've been coaching our 100 property entrepreneurs through every single step of this and second guessing as best as we can what's going to happen. And, very fortunately, give or take a week, the first 3-month period, the dark period, the model that we created in week 1 was pretty much spot on. We've now modelled phase 2 and phase 3, which is the dusk, and then the dawn and the dials. The dusk, the light's now coming up and we can see what's happening, and we can start to make speculative investment and get first mover advantage. And then the dawn and dials, you know, the dawn, the sun's come up, we can see everything, there's full light, we can drive at pace. And because we've seen economic failure and recovery plenty of times in the past, success and failure are very predictable. We can use those dials, which are basically GDP, government borrowing, interest rates, transaction values, transaction amounts, affordability, finance markets, internet. Obviously, we've got Brexit on top of all this. Anyway, I could go on all day. There's the 3 reasons anyway. 3 reasons why property prices are not dropping, but why they will do. Why they will do in the 6 to 12 months ahead. So, gold rush, ladies and gents. Don't miss the opportunity. Get involved. Join the property entrepreneurs community if you've not already. More content and information in there. And I wish you all the best of luck for a challenging period. But yeah, success and failure are very, very predictable. And the worst recession in 300 years could be the opportunity of a lifetime. So I'll keep you posted in due course. Catch you all soon.